All right. Today is Thursday, the 20th of April. This is a recap for the stock market activities today. Now, folks, I got a good one for you tonight. We begin with the most important story of the day, which is the unscheduled rapid mid-air disassembly of the SpaceX rocket. It's not an explosion, folks. That's misinformation. And of course, here it is, launching. Inflation is over. The bear market is over. We have a soft landing coming. And the Fed is going to cut rates. The bull market just began. To the moon, bruh. Oh, wait a minute. Inflation is sticking. Recession is coming. The Fed is not going to cut rates. And the whole thing went kaput. But hey, at least they gave it a shot. We'll get it next time. But it was a bad day all around for CEO Harry Bowles because it's not just his rocket blew up. It's also his souffle. It was down about more than 10% or so. Kind of weird, you know. The most popular stock goes down by 10% in a bull market because of what? Why? Why would it go 10%? For what? This is a bull market. Corporate earnings are better than ever before. Oh, wait a minute. Yeah, they went down 20% year on year for the souffle. But folks, it was a bad day across the stock market. So what happened? Did we get any good news? Did we get some news of economic expansion or recovery? Because we know that the stock market loves bad news. And the reason is bad news equals more cocaine by the Fed. But today was bad news after bad news after bad news. So you'd think the stock market would have rallied, I don't know, 2%, 3%, but it was slightly down. What happened? Overnight, we got the news that Taiwan Semi's earnings, not so good. And they have a warning for the chip industry. Number one, demand is slowing down. Number two, we have a glut in inventories. Maybe the chip industry should try Ozempic and get rid of some of that glut. But in the meantime, this is bad across the board. It's not just Taiwan. It's Intel. It's Nvidia. It's Texas. It's all of them. They have an enormous amount of inventory. It's the bullwhip effect. They thought demand from 2020 and 21 is lasting. They ordered and manufactured a lot of stuff. And all of a sudden now the demand is no longer here. It was transitory and they're left with a lot of inventory. You add to that, of course, the tensions between the US and China and the restrictions. It doesn't look good for chips here. I know Taiwan was blasting higher because it was down beforehand. It's a relief rally, etc., etc. But this is not a good leading indicator for chips. And chips, in a nutshell, are a leading indicator for the economy. If chips are doing good and having high demand and low cost, then this is a good leading indicator for the rest of the economy. But when the chip industry starts to slow down and talks about, oh, demand is going down and we have a lot of inventory right now, this has ripple impacts across the economy, from electronics to automobiles to large medical and industrial products. There is a ripple impact of the slowdown in demand that we will see across the economy, starting with chips, and then it goes and spread all over. You can see this from other pieces of data that we got today. We'll take them one step at a time. Existing home sales, that's bad, down about 1%. And this is, by the way, the biggest drop in a decade. We are now at the same levels of 2020 and the housing crisis of 2009, 2010. But somehow we have expectations of a soft landing and the beginning of a new bull market. Okay, and then we got the new Philly Fed Manufacturing Index, and that was yet another disaster, deeper into contraction territory. And as you can see, the trend is down, not as bad as 2020, but we're getting close. And ladies and gentlemen, these are horrific readings. You gotta understand that back in 2020, when we had the Great Panic and we locked down and we shut down everything, that was an artificial crash in manufacturing. It was man-made. Now we're having an organic crash in manufacturing and the economy. And again, just like chips, manufacturing is a leading indicator. Little by little, what's going on in manufacturing spreads all over the economy, including services. Furthermore, a lot of these people, they keep saying that, oh, we're going to have a soft landing, a recession is just overblown, recession is not going to happen. Well, not according to the Philly Fed Manufacturing Index. Every single time we got this deep into negative territory when it comes to the reading, we got a recession. So you can dismiss the yield curve inversion, you can dismiss the ISM readings, you can dismiss the correlation between the Fed funds rate, the unemployment rate, and recession. You can dismiss the Philly Fed Manufacturing Index. You can put your blindfolds on. That's up to you. But the data says we're heading into a recession. We have never had a stock market with these kind of multiples into a recession. Never. We never had a bull market, a start of a bull market right before a recession. Never happened before. But hey, there is a first time for everything. Maybe it's going to be the one. And of course, when we look at the Philly survey, we look at prices received, that's also crashing now in negative territory. So the bulls will look at this and say, look, we have disinflation in the economy. So far, so good. Boom. The Fed cuts rates. All-time highs. Now, the bears in the recession camp will look at this and say, no. Prices are going down for the wrong reasons. Prices are going down because the economy is slowing down dramatically. The demand is disappearing day by day. Of course, there's the stagflation camp that says, sure, manufacturing is already in a recession. In the meantime, other sectors in the economy, be it housing, services, that remains in an inflation mode. In other words, we will have a stagflation phenomenon in the economy. And then we got leading economic indicators down 1.2%. The estimate was down 0.7%. So this is absolutely insane. The biggest decline in 3 years. But I know this is just a perma bear, Marvik. You don't know what you're talking about. Here is maybe a more legitimate perma bear. How about Peter Schiff? He says leading economic indicators fell 1.2% in March. The 12th consecutive decline. This is the longest losing streak since the Great Recession in 2008. The rising hashtag stock market has been one of the lone strong indicators, quote unquote, which only rose due to other weak economic data. Hashtag stagflation. So I guess Peter is not in the recession camp. He's in the stagflation camp with me. That's interesting. And here it is. Charles Schwab, Liz Ann Saunders says, in year-on-year percentage change terms, leading economic indicators from the conference board fell 7.8% in March. And by the way, the conference board right now says we will hit a recession mid-year, 100%. Now firmly in recession territory. And in fact, during recessions in the early 70s and 80s, annual decline never got this negative. She ends March leading economic index from the conference board minus 1.2% month over month versus minus 0.7% the estimate, a minus half a point in the prior month, which was, by the way, a downward revision from negative 0.3% to negative 0.5%. She also adds that the contraction is consistent with what was typically in the past few recessions. So all indicators that we got right now say the economy is going to head into a recession. Show me when was the last time we started a bull market right before the recession? It never happened before. It happened maybe once during the wartime, but that's controversial. And then we got jobless claims up to 245,000 jobs, signaling cooling in hot labor market. Listen to this. The number of people getting unemployment benefits hits the highest level since late 2021. So now it's getting a little real. Again, I hate to call them bulls, but these people, they keep saying, oh yeah, all of these problems, it's okay. We're going to have a soft landing because the unemployment rate is too low. The jobs market is still intact. And oh, by the way, the Fed will start cutting rates pretty soon. I showed you the chart before. Fed cutting rates with unemployment rising higher. Lethal combination for the stock market every single time. And as you can see, initial jobless claims, be it the 4-week moving average in blue or the continuing jobless claims, all surging higher. It is just a matter of time before we see this reflecting in the Bureau of Kitchen Statistics data. And sure, the Fed will pause, but it's going to be a hard pause, not a soft one. And then what happened to the stock market? Because all of this bad news should have been fuel. We should have been rallying by 5% today. But, the typical book of this consolidation we've been in since the beginning of the month. We get bad news, stock market gaps down, here comes the dip buyers, the computers, and we see a rally all the way to the end of the day closing flattish. Today, we saw the same phenomenon. Gapping down, dip buyers show up, but then an unexpected, rapid, unscheduled disassembly took place and the stock market went down. What's going on here? My hunch is it's a mechanical reason, but also the market can no longer ignore the facts. We are seeing horrific economic data, number one. Number two, now the jobs market, the untouchable, is being touched now. That's number two. Number three, you can't ignore Tesla. I mean, this is a giant growth company, a darling for the retail mom and pops. And it is clear that the momentum is slowing down dramatically, not just from the demand side, that, oh, demand is slowing down and the competition is heating up and they have to lower prices over and over and over again. But costs are sticky, and therefore the company's margins are getting crushed. Are we going to see the same phenomenon happening in many other companies? And guess what? When we talk to the retail crowd and we say, what could be the biggest negative factor for this earnings season? The professionals, the experts, quote unquote, they say tightening in financial conditions, in reference to banks, of course. They got it wrong because they live in a bubble. They don't live where we live. The retail mom and pops, they say, yeah, tightening financial conditions, that's a concern. But economic slowdown is the number one concern, along with rising costs and high inflation. So the retail mom and pops are spot on here, that the problem is economic slowdown, that slows down the demand, and then you got costs sticking, hence stagflation. And this is going to be absolute havoc to corporate earnings. We begin with Tesla, we'll see what Amazon, Apple, Microsoft, and of course Nvidia will do. But we don't have any good leading indicators here. Take a look, for example, at the Johnson Red Book Index, the same store sales on weekly basis year on year. We're diving down, and soon enough the reading will be in negative territory, indicating a recession. The consumer is getting annihilated out there. They exhausted their savings, they maxed their credit cards, they're stuck in high rents, 40, 50, 60% of their income, high auto loan payments, insane utility bills. They got nothing left to stimulate the economy with. You can say, oh yeah, it's a bull market because look at Apple, look at Nvidia, look at Microsoft. Who fuels the earnings of these companies? The answer is the consumer. The consumer is weakening across the board. We talked about UK data last night. If the British consumer is suffering from high inflation and their wages are down 3-4%, real wages we're talking about, what do they got to stimulate the economy with? What do they got to buy iPhones and to buy chips from Nvidia and buy shit from Amazon? That's recessionary. We're going to start to see those indicators showing up in corporate earnings. And on top of that, Citi says that stocks face a hit as the $800 billion stimulus is fading. The analyst from Citi says we now expect almost all of them to stall or go into outright reverse. We think this could subtract $600 billion to $800 billion in global liquidity in coming weeks. We're talking about the Fed here taking liquidity out, undermining risk in the process. With peak liquidity in the past, we would not be at all surprised if markets were now to experience a sudden pressure loss, aka the rug pull. But I know the Maverick of Wall Street is just a perma bear. He has no idea what he's talking about. Okay. Others have also become skeptical of the risk rally this year. Nick Ferris, Chief Investment Officer for hedge fund Vantage Point Asset Management, said equity markets pricing was overly optimistic. Market breadth supporting the rally has been extremely poor. Yesterday I showed you it's 3 stocks, really. It's Apple, Microsoft, Amazon. You can lump Nvidia into those. You got 4. What else? Meta? But here's the most important part. Equity investors appear to want all the benefits of rate cuts without enduring the pain that would warrant them. Are you listening or not? Rate cuts actually bearish. Be careful what you wish for. If we get rate cuts, we're going to get them for the wrong reasons. And every single time, I showed you the data. When the Fed start cutting rates, the unemployment rate surges higher, and here comes the recession and the crash in the stock market. Every single time. And again, the whole stock market rally revolves around 4 to 5 names: Apple, Microsoft, Amazon. You can talk about Nvidia and Meta, sure. We know Tesla's gone now. So the question is, according to the Bloomberg survey, what do you think tech earnings will be? The vast majority, 59%, say that the rotation to the technology sector has nothing to do with this sector's earnings in the first quarter. So the stock price action is divorced from fundamentals. This doesn't last for too long. 27% say disappointing. Earnings by tech will be disappointing and will stop the rally in the sector. 14% say strong enough to fuel the rally in the second quarter. And here it is, folks. 25 basis points and then pause. We talked about this last time around. We talked about this in February, in January, in December, in November, in October. 1 and they're going to pause. 1 and they're going to pause. And they keep going. But now it appears more likely because we're getting more and more abysmal data. And little by little, we're going to get a piece of data that shows that unemployment is actually rising in the economy. The economy is losing a lot of jobs. That is the moment when the Fed is going to pause. But is it going to be a good pause at that point? I doubt it. Because the bulls, or these people, if you recall last year, been crying, oh, the Fed is overdoing it because the lag impact. So how could you celebrate a Fed pause when there is all of this lag that is being built up? Have you forgotten about the lag? And now all of a sudden interest rate pauses and cuts will do the magic? It doesn't appear so. But folks, we have to keep an open mind here because we have plenty of earnings to come. We have Apple, Amazon, Microsoft, Nvidia, Meta, and most importantly, a lot of cyclical names in the economy, from consumer staples to industrials to metals. Let's see what they have to say. That would serve as a great leading indicator to what's about to happen. One step at a time, but for now, we have to move on and cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average down by 110.39 points, or a decline of 0.33%. The Nasdaq also down by 97.67 points, or a decline of 0.80%, leading the pack to the downside this time around. S&P 500 also negative by 24.73 points, or a decline of 0.60%. When we look at the sectors, pathetic across the board, with defensives barely in the green. I'm not going to give any medals today because it's all due to Costco, really. But the rest all negative, led by cyclicals, followed by real estate, metals, energy, and technology. Awful day, and perhaps a reflection of the economic data that we got today. Maybe finally the stock market actually reads the bad economic data as, well, bad news. When we talk about the breadth, the NYSE 27% advancing versus 72% declining. The Nasdaq 29% advancing versus 68% declining. Now we have options expiration coming out tomorrow. It's going to be a big day, and the job of the market maker is closing neutral. They're going to make a move in the morning, and it could be, let's say, a gap down. And the goal from this operation is to close all of these calls out of the money, at least scare them away, and get some bears and shorts a little too excited to buy some puts, and then flush them down too by the end of the day by creating a rally to go back to the flat line. That is the job and the mission by the market maker. Are they going to succeed or not? That depends on the volume. If we have large volume by the institutionals and the retail mom and pops, the market maker's ability to manipulate the stock market is limited, but they can do a pretty good job under low volume. Anyhow, moving on to commodities, what do we see here? The dollar is down. You'd think this is good for commodities, but again, in a recession theme, the dollar goes down along with commodities and along with stocks. And we see maybe gold and silver outperforming. This is exactly what we saw today. Gold slightly higher, but not by much. Silver pretty much in the flat line, but we see copper down by about 1.5%. And then most importantly, we see energy down across the board. The WTI, Brent, all down more than 2.5%. Gasoline RBOB down by about 2%. Heating oil down more than 2.5%, and natural gas also lost some ground here, down by about 1%, although it was a much worse day earlier on for nat gas, but we got a rebound. So again, we're going to see a little bit of resiliency here in nat gas because it has been battered, bruised, destroyed, while the rest of the commodities has been holding ground, if not rallying. And then we have another notable mover in sugar futures, up by about 4% today alone. The rally has been insane, and you can capture the rally in sugar by the ticker CANE. C-A-N-E. It is absolutely exploding higher. We're going to talk about why sugar futures are rallying and how can we play the rally in sugar using stocks in a separate video. Moving on to the big casino, the options market, what do we have here? The volume all in all remains shy with exception of the most important names, namely Tesla, with around 4 million contracts traded today. About 53% of those were calls. So we still have some buy the dip opportunities. But again, in this program, we've been talking about the behavior of Tesla's chart and how inviting it is to the bears. We see rallies failing all the time, pops and then dumps. This kind of behavior smells blood, and the bears are going to hop in, and once they start to pile in against the name, they're going to shred it to tears. And we see Tesla down by about 10% for the day. Now, sure, we could see rebounds, but the momentum right now shifted to the downside. We're going to see more and more pain in Tesla. And then at number 2, Nvidia, with around 900,000 contracts traded today, and the volume is split down the middle line 50-50 for both calls and puts. Amazon at number 3 with around 900,000 contracts traded today. About 71% of those were calls. We see a lot of call options buying in Amazon. It was successful in the past of inducing a gamma squeeze, but now even Amazon is slowing down along with the rest. When we look at the VIX, again, we see a lot of call options buying in the VIX. We're talking about tens of millions of dollars. A lot of folks are not buying that, hey, it's over. The VIX is going to go down below 17, and this is the beginning of a new bull market. A lot of them are rating this as a bull trap. The VIX goes below 20, marks the low of the year, everybody's fooled, and then we see the VIX blasting significantly higher, and here comes the reversal of the stock market. Yesterday we talked about a large trade worth over $20 million. Now we have another one, the 30 calls for September expiration, and that was about $12 million. So we're seeing large bets here that the VIX will pop. A lot of traders are not buying the bullish narrative here. Moving on to the unusual activities that took place in the options market today, we begin with the ticker TSLA, Tesla. Of course, after a massive drop, 10% plus, you're gonna see some short covering, you're gonna see some profit taking, and that could produce a bounce. This is what the trader here is betting on, buying the 172.5 calls. The expiration date, April 28, with expectations that Tesla could rebound and gain more than 6% by then. They paid around $1.85 a piece to enter this trade, all in all spending around $2.5 million. And then we have the ticker IYR for the real estate ETF. It doesn't do pretty good when rates are rising, but it also doesn't do pretty good when rates are diving down due to a recession. In the meantime, we see confusing signals. Rates go down before a recession, in anticipation of that recession, and we see the real estate sector or technology receiving the wrong signal. Or rates are going down, that's good for us, until we realize that rates are going down for a recessionary reason. And therefore, somebody's buying puts here in the IYR, the 79 puts, the expiration date May 19th, with the expectations that the name will go down and lose more than 6% of its value by then. They paid around 55 cents a piece to enter this trade, all in all spending around $550,000. And then we have a put spread for the Qs. Somebody sees it going down, they bought the 294 puts and they sold the 288, all for the expiration date June 2nd. And again, it's a tight range because the trader is expecting 7% downside, but not more than 9. They paid around $2.50 a piece for the 294 puts. They received about $2 a piece as credit from selling the 288 puts. So you got the entry cost all the way down to 50 cents a piece. But the max profit limited to $6 a piece. It's a really good trade because if it works out, the trader turns out 50 cents to $6 a piece. That's an enormous profit. But anyhow, they paid 50 cents a piece, and that brings the total all the way to about $350,000. Then last but not least, what about the ticker POOL? Pool. I believe the name reported earnings today and it was good. The reaction was positive, but somebody's fading the rip here. They're buying the 300 puts with the expiration date May 19th with expectations that the name will go down and lose more than 10% of its value by then. They paid around $4 a piece to enter this trade, all in all spending around $2 million. Moving on to the heat map, what do we see here? No theme, of course. We have earnings season and names are bouncing or crashing based on earnings. We see a lot of losers in the names that reported earnings, be it in financials, be it in American Express, Philip Morris in Staples, Tesla, of course, and the rest of the manufacturers all down. GM, Ford, Lee. In healthcare, we see names such as the Diagnostics, Thermo Fisher, Donner all down due to earnings. And then in chips, we see TSM moving higher due to earnings, but NVIDIA going down. I believe that NVIDIA is going down in empathy with Tesla. Both retail mom and pop kind of names. They stampeded in buying these names. Tesla serves as a warning that, hey, maybe NVIDIA will face the same problem here. And of course, then we see some other chips manufacturers actually moving higher, led by Lam Research, LRCX. We see a bounce in ASML, but then really troubling here, the old school technology names, Cisco, Dell, all down big repeatedly, day after day. And the big caps, of course, are down. Apple, Microsoft, Amazon, even Meta's down, with the exception of Google, due to AI optimism again. And then we see a mixed picture in the rest of cyclicals. For example, the apparel stores, TJ Maxx, Lululemon, Ross, all moving higher. Even the auto parts stores such as O'Reilly, AutoZone, all moving higher. Although AutoZone or O'Reilly been rallying significantly higher, they were overbought right now. The risk is to the downside. A value name is actually the ticker AP, Advanced Auto Parts. I have some call options on the name. It could be a takeover target. It could be a value play. We'll see what happens. But we see travel names down, Expedia, Booking, all down. Yet resorts are lighting up in the green, led by LVS, Las Vegas Sands. And this is, of course, an earnings mover. When we look at defensives, mixed picture, but mostly in the green, the winner of the day, led by, once again, Costco. Every dip is bought in Costco. It is a reliable outperformer, closing the day with gains of about 2%. Now, you could say that Costco is expensive as a stock. It's not cheap, but it is a reliable outperformer for now. It's a go-to. When you're confused, when you have no idea what to buy, Costco always delivers until it doesn't. Moving on to the heat map for the ETFs, what do we see here? Muted, slightly down, no notable movers here one way or the other. We see pain in energy, XLE, XOP, in real estate, the IYR, in financials, KRE, even in the biotech, we talked about biotech, pullback coming, XBI down about 2%. Even gold miners are down for the day, and chips, SMH, technology, XLK, all down. And the only winner is the ITB and the XHB. These are home builders, construction, and the reason is DR Horton did report earnings today, and it was a blast higher, although it did close at the lows of the day, so it could be a sign of a reversal here to go down and close the gap. In the meantime, what do we do with this kind of reaction? Bad economic data, everything for the most part is down to muted, even gold. Are we going to see more of that, ladies and gentlemen? Because if we have a recession, and it is a deep recession, sure, you can see some outperformance by the XLP, for example, staples, some outperformance by the XLU utilities, although I believe that a lot of utilities are not cheap, and maybe the only reliable outperformer should be gold. But then there's the conversation of, do we go with the GLD or the GDX? GLD is closer to the commodity. GDX is gold miners. Now understand, with gold miners you have input cost, and gold miners need demand. If the economy slows down drastically, demand will slow down. So I would say the GLD over the GDX because it tracks the commodity closer than the GDX. Let's do some charts and then wrap it up. We begin with SPY, 30 minutes chart. What do we see here? Believe it or not, before the bears get too excited today, nothing happened. We're still within range. Support 410, resistance at 416. You could take that down to 415, whatever float you bought, doesn't matter. But we are within range. Had we closed below 410, I would have said, okay, we have a warning sign here. The bears are closing in. But for now, it remains within a range close, nothing happened at all, although we do have signs of weakness. If we clean up the chart a little bit and we use a line chart, what do we see here? The potential, keyword potential, of a rolling top pattern. But the confirmation of a rolling top pattern should be losing 410. That has yet to happen, folks. So here's the daily chart for the continuous contract for the S&P, the E-mini futures. Volume moving higher, that's bearish, not bullish. The momentum is stalling and curling down, whether we're talking about the RSI or the MACD indicator. Look at the MACD. It's about to cross, it's about to show negative impressions, negative bars on the histogram. If we close negative for the week, that would be a really ominous indicator. Better yet, if the futures lose 4,100 as support, then we got a confirmation of a reversal. And then we have earnings, and that could be a double whammy. And believe it or not, this is not really science, but it is an observation throughout the years. When we have weak technicals and they turn around and they become bullish, and then we have earnings. Believe it or not, even if earnings are bad, the stock market reacts positively to these bad earnings. Company so-and-so misses earnings, the stock shoots up higher anyways. But we see the inverse phenomenon if we see technicals rolling from bullish to bearish. And then we have earnings. We could see companies beating top, bottom lines, yet the underlying stock goes down 5-6% anyways. And I believe that we're getting to this phenomenon here. If the SPY turns negative, if we see a negative impression on the histogram and it loses 4,100, I believe we'll see this phenomenon. Companies delivering better than expectations earnings, but they go down anyways. SPX, cash index, what do we see here? It appears that we have a double top for now. It appears that we're about to crack below the steep trend line. But mind you, the confirmation for all of this is losing 4,100 by the end of the week. Sure, the RSI is breaking positive divergence into negative. Soon enough, the confirmation will come from the MACD. You put 2 and 2 together, the SPX will lose 4,100 as support. But we gotta see it, folks. What about the Qs? 30 minutes chart, what do we see here? Similar phenomenon. We get a gap down, dip buyers show up, they close the gap. So far, so good. And then all of a sudden comes the reversal out of the blue. It's a mechanical reason. The market maker is not gonna let you win, be it put options or call options holders. They took care of the put options holders by consolidating the market for a few weeks now. And the VIX went down below 20, below even 17. That is death to put options. They're all out of the money now. And even if they're close to the money, they lost a lot of value. Call options, sure, they lost a lot of value from consolidation, but they're closer to the money right now. The market maker doesn't want you to win. So they flush it down before Friday. Maybe they flush it down again in the morning. We go to a test to 313, let's say. The bears get excited, they buy puts, and then the market maker moves us higher again, closer to 316. This is what they're aiming for. But if we see panic, if we see a lot of retail mom and pops, a lot of institutionals saying, okay, Tesla bad, what's next? Let's take some profits here before the weekend and then go home. Then we can see a test to 313. That cracks and we go down big. What is the bullish outlook here? Could we see another pop higher, for example, tomorrow? Yes, we could. The question becomes, what is the market maker doing by a gap higher in the morning? What are they trying to achieve here? If we see a pop in the morning and it doesn't recapture 318 as support, it's fake. They're going to trap you, the bulls, buying calls, flush you down by the end of the day. In the process, a lot of put options holders are even more frustrated right now. And by the time the chart goes down to 313, there's no point of buying puts anymore. You got to wait for next week. And when we look at the pattern all in all, we have a pattern of lower highs and lower lows. So the bears, little by little, starting to gather some momentum here. But they need a lot more. They need 313 to mark the death of this rally. When we look at the daily chart for the continuous contract, what do we see here? Nothing happened today, folks. Support remains at 13,000. Resistance at 13,300. Do we have warning signs? Sure we do. Number one, the volume is up. That's bearish, not bullish. Number two, negative divergences on both the RSI and the MACD. Once again, bearish, not bullish. What if we close below 13,000? That would be a minor win for the bears. Not a major defeat for the bulls at all. But if we go down and we lose 12,766, then you bet it is a major win for the bears, major defeat for the bulls. IWM, an hourly chart, what do we see here? We don't have a pattern of higher highs anymore. Do we have a pattern of lower lows? Not quite. The gap is still here, still holding. So for now, the IWM is neutral, but slightly negative. If the support line of the gap is broken, we go down to 174.22. That's not going to hold at that point, which means we flush down to 168.90 and then take it from there. Dixie, 4 hours chart, what do we see here? Despite all of the bad news, all of the negative recessionary piece of news that we got today, from the Philly Fed, from leading economic indicators, from continuing jobless claims, and the Dixie's holding ground. Sure, it's not above 102, it's not support yet, but boy, it should have been down big today. The fact that we have relative outperformance by the Dixie says that higher we go. It is shrugging off bad news and saying I'm holding ground here because I want to go higher. You guys said the Fed is going to do 25 and then pause. I say not so fast. I think the Fed will do 25 and maybe not announce the pause and wait for data. And data will come out and show that inflation is not dead, which means the Fed will have to do another 25. This is what the Dixie is saying right now. It wants to go higher. If that is the case, not going to be good for equities and certainly not good for gold. Gold right now, the old man holding ground, forming a bear flag pattern, losing a little bit of momentum. If the dollar makes it above 102 by the end of the week, it is a safe assumption that gold should be pulling back to 1928, if not all the way down to 1900. And the same goes for silver. SLV forming a bear flag, losing a lot of momentum, negative divergence on the RSI, confirmation in the MACD. Give it time. Let it pull back, let the dollar shows whatever move it wants to show before the FOMC, and then if the dollar reverses down after Powell, silver goes higher again. And that would be the moment you want to buy silver at. How about UK oil? Brent, not good. The bears are gaining momentum here. They crushed 85 for support, they crushed the trend line, now they're aiming at closing the gap and then going down at 77 again. The bulls must make a move sooner than later. Recapturing the trend line at a minimum would prove that oil bulls are still alive. But again, we talked about this before. Oil bulls would say, okay, I'm not selling. OPEC Plus gave us the pump, I'm going to wait here. But if the buyers don't show up, I'm going to take profits at better prices. And this is what we're seeing right now. The rally stalled. It failed to build any momentum after that. A lot of holders are now booking profits, saying, okay, no more. Let's book profits and then see what happens. How about the 2-year? What do we see here? Facing resistance, pulling back. Is it a reversal? I wouldn't say so, although we had really bad economic data. You'd think the 2-year should have flushed down. It did not. It lost yesterday's candle, but it closed at the lows of the day before, which means it's a pullback for now. It could be a process of gathering energy, and then we see the 2-year cracking above this resistance line, or perhaps closing the gap above at 4.59%. And if that happened, it would certainly rattle the stock market. How about the TLT bouncing off 103.5, but can you believe it? Can you buy it right now? Not according to the guy you're listening to right now. You know my number, 109.5. Otherwise, it could be a trap, and down we go. About the VIX, 4 hours. What do we see here? The positive divergence in the RSI is playing out. We got a gap higher in the VIX today. Folks who've been holding put contracts on the VIX, when these contracts expired in the money yesterday, what happened? They have to buy volatility. The holders of these contracts, they have to buy volatility. And they did buy today, and we see it above 17. You add to that all of the call options buying, be it from 50 cent or not 50 cent. I don't think 50 is here yet, but I think he will make a comeback. And once we see his trade, the VIX is going to pop significantly higher because the market right now is wired that 50 knows what's going on. And if 50 says I'm going to buy the 25 or 30 calls or whatever expiration date, it becomes a self-fulfilling prophecy. What about Apple? The big kahuna, an hourly chart, what do we see here? It is stalling. It gave it a shot yesterday at 167.88. Didn't make it. Gave it a shot today. Couldn't make it either. So we have a double top right now. Is it over? Of course not. Apple could give it a shot tomorrow at 167.88, but it failed twice. It needs more energy. If it doesn't find the energy right now, it's going to go down to closing the gap. If it doesn't find energy at that point, more likely not going to happen. It goes down back to 163.33. See if it has some buyers at that point. Tesla, an hourly chart, what do we see here? We talked about 167.5. The chart did open pretty much exactly at that point. It recaptured that support line, but it couldn't keep it. And it flushed down significantly by the end of the day. Now the chart is really oversold. You look at the hourly, the RSI, way oversold. I would not be surprised to see an attempt at least. Or short covering, profit taking, dip buying, maybe give it another shot at 167.5. But the damage is done, folks. When we look at the daily chart, what do we see here? Below the important line, plenty of room to go to the downside. And of course, we know the bears target at 144.43. They want to close the gap and then take it from there. We talked about how we get closer to 150, the retail mom and pops will capitulate. A lot of them are ouching right now, but most are still in the money. If we go down to 155, 150, they're going to start to panic, and they will get the chart all the way down to 144.43, if not even below that. So keep an eye on Tesla. Weekly chart, what do we see here? Losing a lot of momentum, be it in the RSI, be it in the MACD. We have a confirmation now. 144.43. That's target number one, and then we take it from there. It could get a lot uglier, but one step at a time. How about Nvidia, an hourly chart? What do we see here? The bulls were betting for an ABC pattern, which will take us all the way closer to 300. This is not happening. We have instead a double top. The chart lost 274. That's the point for the bears. But the bulls would say, hey, we closed exactly above the gap. We got a bounce from the gap and closed above. So far, so good. The bears will counter and say, we ran out of time. We'll get it tomorrow. Nvidia goes down. We have support at 266. After that, we have 264.14. And lastly, the most important support at 260. You can play the pullbacks all you want, but for me, I'm not going to open a major short for Nvidia. Let's say September, October expiration, investing hundreds of thousands of dollars in the trade. I'm not going to do that until Nvidia loses 260 as support. But we have good indicators here that Nvidia will go down. We'll look at the weekly chart. What do we see here? Overbought in the RSI, curling down in the MACD. Bad looking candle so far. We still got one day, but everything is indicating here that Nvidia stalled. Whoever wanted to buy Nvidia is already in. Okay, so you guys bought. Now what? What happens next? Who's left to buy? Nobody left to buy. There are only the holders who are looking around and saying, okay, this thing's not moving anymore. I better book profits. And that becomes kind of contagious. Even if we have a group mentality, like we saw back in AMC and GameStop. Diamond hands, hold, don't sell. That's all bullshit. At the end of the day, folks want to make money. And if you bought at 200, 160, you're up big. You want to book those profits. You're not going to sit here and watch it go down to 260, 250, 240. You want to book these profits and be greedy right now. This is just human psychology. It's going to play out, and we see Nvidia moving down sharply. And last but not least, what about tulips, Bitcoin? What do we see here? Look at what happened. We're back at the zone again. We're back at the consolidation box once again. Lost 29,200. The rally was a fugazi. The pop was a trap. At least for now. We see a negative divergence in the RSI. We see a negative momentum in the MACD indicator. It's not the worst outcome yet. That would happen if Bitcoin loses 26,555. Then we'll see a lot of selling taking place and we could see a big flush down. But one step at a time, folks. So let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the flash PMI for services and manufacturing, and then we have from the Fed, Governor Lisa Cook. On the earnings calendar, we have Procter & Gamble, we have SLB, and then we have Freeport-McMoRan. With that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again over the weekend. Take care.
I am so high.